Ladies and gentlemen, good day and welcome to Vaibhav Global Limited's Q2 and H1FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Disha Shah from Adfactors PR. Thank you, and over to you, ma'am.
Good evening, everyone, and thank you for joining us on Vaibhav Global Limited earnings conference call for the second quarter and half year ended 30th September 2024. Today we have with us Mr. Sunil Agarwal, Managing Director, Mr. Nitin Panwad, Group CFO, and Mr. Prashant Saraswat, Head of Investor Relations. We will begin the call with opening remarks by Mr. Sunil Agarwal on the business operations, key initiative, and a broad outlook, followed by discussion on the financial performance by Mr. Nitin Panwad, after which the management will be open for the forum for Q&A session. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties that we face. A detailed statement and explanation of these risks is included in the earnings presentation, which has been shared with you all earlier. The company does not undertake to update these forward-looking statements publicly. I would now like to invite Mr. Sunil Agarwal to make his opening remarks. Over to you, sir.
Thank you, Disha. Good evening, everyone. Thank you for joining our Q2FY25 earnings call. I hope you reviewed the results and investor presentation. I am pleased to report a 13% revenue growth, reflecting our continued momentum. Consistent with our guidance, we maintained strong gross margins at 63.5%, supported by strategic pricing and favorable product mix. Our vertically integrated supply chain has also enabled us to achieve stable and market-leading gross margins. EBITDA margin came in at 8.7% of revenue compared to 9.5% for the same period last year. This decline reflects planned investments in digital marketing aimed at new customer acquisition, high airtime costs to secure a better channel position in the US, and airtime costs in Ideal World. These investments are expected to drive long-term gains in new customer acquisition, as reflected in our record unique customer base of 682,000. Now, let me take you through our key retail markets. The US revenue declined 1.6% year over year in the September quarter, affected by increased attention on the election activities and Olympics. With consumer confidence improving and the elections now behind us, we expect demand to pick up in the upcoming holiday season. In the UK, revenue grew by 15% year over year, majorly contributed by Ideal World. With signs of improvement in UK economy, like the consumer confidence index inching up, inflation and interest rates going down, we expect recovery in consumer demand in coming months. Additionally, Rachel Galley, an e-commerce brand we acquired in the UK 3 years ago, has now achieved EBITDA profitability. This highlights our capability to scale e-commerce brands and achieve profitability, demonstrating our disciplined approach to growing digital businesses. Germany continues to perform well, recording 15.3% YOY revenue growth in Q2 FY25. Q-on-Q revenue grew by 25%, while operating losses declined substantially by 41%. We are confident of achieving break-even at the operating level by second half of FY25. Our 4R strategy, that is, widening reach, new customer registration and acquisition, strengthening customer retention, and repeat purchases, continues to deliver positive outcome. Our TV network now reaches 130 million households, and our unique customer base has increased by 51% year over year on approximately 682,000. Even without any new acquisitions, the unique customer base grew 6% YOY. Customer retention stands solid at 41%, with an average of 23 pieces per customer annually on a trailing 12-month basis. We have now completed 1 year since acquiring Ideal World and Mindful Souls, and I will provide a brief update on their progress. Ideal World operates 24/7, reaching 27 million UK households. We recently upgraded our Sky broadcast to HD network. The business is currently profitable on direct cost basis, achieving £17 million in sales over past 1 year. We expect Ideal World to reach full cost profitability from current quarter onwards, that is Q3 onwards. Mindful Souls continue to perform well, with PBT margin of 10% on trailing 12-month basis. Mindful Souls now has a solid base of over 100,000 unique customers, which we aim to grow further. Leveraging VGL's group's supply chain, we are further enhancing its profitability through better costs and are regularly launching new subscription boxes. At VGL, community impact remains a key focus. We recently reached a milestone of 93 million meals being served to school children under our Your Purchase Feeds initiative. We are currently donating 54,000 meals every school day. Our long-term goal is to reach 1 million meals every school day by FY40. On sustainability front, we generated 1.1 million kilowatt hours of solar energy this quarter, meeting 100% of power needs for 2 of our manufacturing units in India. This aligns with our goal to achieve carbon neutrality for Scope 1 and Scope 2 emission by 2031. We are honored to have received the Excellence in Sustainability and Climate Action Award from Indo-American Chamber of Commerce at the 20th Indo-American Corporate Excellence Conclave. This award recognizes our contribution to Indo-US trade, business, and our commitment to ESG principles. We look forward to keeping a balance between growth, investment, and quarterly payouts to generate sustainable value for our stakeholders. Thus, the Board of Directors has declared an interim dividend of Rs 1.5 per share for the quarter, representing 89% of payout and implying a firm belief in our business model and strong growth prospects. We remain vigilant in tracking the macro environment and market trends. I am confident that our capabilities, team, and experience will allow us to sustain profitable growth. We reaffirm our FY25 revenue growth target of 14 to 17% with operating leverage and project mid-teen revenue growth in the coming years with decent operating leverage. I will now hand over the call to Nitin to discuss the financial performance in detail. Over to you, Nitin.
Thank you, Sunil. Good evening, everyone. Welcome to Vaibhav Global's earnings call. Following Sunil's overview of business performance, I will now cover the financial results for Q2 and half year ending September 24. In Q2 FY25, we recorded 13% year-over-year growth, totaling 796 crore rupees, up from 705 crore rupees in Q2 FY24. In constant currency basis, this reflects 10.2% growth, supported by a 9.3% rise in our volume. Our gross margin remained strong at 63.5%, benefiting from our vertical integrated model and favorable product mix. The EBITDA margin for the quarter was 8.7%. As Sunil mentioned earlier, the current margin profile reflects our ongoing investment in digital marketing, enhanced channel positioning in US, and airtime cost in Ideal World. Sequentially, content and broadcasting expenses as a share of revenue fell to 19.4% in Q2 from 20.6% in Q1, and we expect that this to reach 18% for full financial year. Profit after tax for the quarter was rupees 28 crores. Looking at regional performance, US revenue decreased by 1.6%, UK posted a 15% revenue growth, and Germany revenue grew by 15.3% year over year. As noted earlier, the existing business growth rate was affected due to audience focusing more on the US election, Olympics, and cautious consumer sentiments in UK. In Germany, revenue growth remained strong, with quarterly operating losses sequentially decreasing by 41%, and we stay on track to achieve break-even level at operating margins in the second half of the financial year FY25. For Q2, TV revenue reached rupees 456 crores, while digital revenue totaling 294 crore rupees. TV revenue grew by 12.3% year over year, and digital revenue increased by 11.8% year over year, with digital contributing 39% of total B2C sales. This growth reflects our continued investment in digital marketing and related infrastructure. Additionally, our budget pay EMI option contributed 38% of total B2C revenue. We have now completed a year since buying Ideal World and Mindful Souls. Ideal World remained profitable on direct cost basis, and we expect that it to achieve full cost allocation profitability from Q3 onwards. Mindful Souls continues to perform well, achieving a 10% PBT margin over the past 12 months. With visual supply chain now supporting Mindful Souls, we expect further improvement in its profitability. Our balance sheet remains strong with net cash position positive of rupees 100 crores. Free cash flow and operating cash flow were at rupees 11 crore and 26 crore respectively, which were affected by planned inventory built up for upcoming festive season. Currently, ROCE and ROE was 17% and 10% respectively. We are also committed towards creating and sustaining value for stakeholders and are pleased to announce that the board has approved second interim dividend for the year of rupees 1.5 per equity share, reflecting 89% payout. Looking ahead, we stay committed to deliver strong returns to our stakeholders in the mid to long term. We are confident in achieving our revenue growth target of 14 to 17% for FY25 with operating leverage, and project mid-teen revenue growth with decent operating leverage in coming years. Thank you. Over to you, moderator, for Q&A.
So shall we start with the Q&A?
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rishabh Shah from Bugle Rock PMS. Please go ahead.
Yeah, hello. Am I audible?
You're quite low. If you can just increase the volume.
Hello? Hello?
We are unable to hear you loudly, sir. If you can speak a bit louder.
Yeah. So my first question is, so sir, budget pay in US and UK is high. So why give products on credit and why not take it upfront? Is it because of the nature of the people living in those countries?
So budget pay ratio we offer based on the customer internal credit score, and customer can opt the budget pay option for the different products based on their EMI available for the particular product. We are offering since 2016, and we have seen quite a good acceptance with the very low bad debts rate of the budget pay, and we're seeing customer traction towards especially buying on the high-end products where they can buying for paying upfront as a full amount and paying in an installment it gives a ease to pay to the customer. So looking to the low bad debts rate and customer acceptance, we are continuing to offering the budget pay within the internal credit assessment of the customers.
Okay. And so my second question is, sir, to Mr. Sunil sir, where do you allocate most of your time? Is it the product design, which is the most important part of the business, or is it just team building or customer acquisition?
So this is Sunil. So I assume you're asking this question from me. So in initial years, I spent quite a bit of time in product development and strategy in the product strategy. But last many years, a majority of my time goes in team development. So I meet the team regularly, my direct reports and my skip levels and some outside stakeholders as well. And in addition to that, I read a lot. I read trade publication and books published by renowned businessmen or strategists.
Okay. So my next question is, as we know, the people pay by invoice in Germany, and there has been a delay to get a break even in Germany. Now we are EBITDA level positive. So what has and what do you think has changed? Because you had entered Germany before also. So now, what has changed that you have entered Germany again? Have you studied the mindset of the people, and how is it different from UK and US?
Yeah, so this in television business, the costs are largely fixed. So we have about 130 people there. Those people will be needed whether you do €1 sale or 25 million euro sales or 30 million that we currently have. And also the airtime that we contracted for about 35 million homes, you would pay them irrespective of what revenue you get. So the fixed cost nature of the initial cost nature of the business is such that once you start to get to a critical mass of customer which have good high repeat purchase intensity, then the leverage of this model is very high. But initial 3-4 years that it takes for this business to assemble that critical mass of customer is needed for this particular business model. In opposed to the other models where you have one store and that one store becomes profitable sooner, in this case we have a store in everybody's living room. About say 35 million homes living room, we have stores there. So we have to set up that store cost right at the front. And that is why it takes time. But the model's beauty is that once you reach a critical mass, a large portion of gross margin then starts to flow to the bottom line.
Okay. So my next question is, sir, in one of the calls you mentioned our revenue per household just $2, and the closest competitor is about $7, and the leader is at $60. So how has that evolved, and what steps have been taken to go nearer to the leader?
Yeah, so we have gained market share over last many quarters, maybe last 4-5 years. We continue to gain market share. So our current run rate is around $3.50. Yeah, so 3 something. I don't have the exact number in front of me. So let me take it. Rather than per household, our current market share is about 4% compared to Curate and Shop HQ that we calculate internally, and that grew from less than 2% few years ago. We continue to gain market share over the years, and I'm confident that we'll continue to gain market share for many years to come, owing to our vertical model and agility to bring the trendy products to the customer in very short time, because we are so closely aligned with supply chain.
So, just a thing on market share. You think we have gained market share continuously over the years. So, shouldn't we have gained market share at a more rapid pace since you only say we sell the products at 50% price of our customers. So, has the leader lost quite a bit of market share in the previous years, or we are lagging somewhere, sir?
So I don't remember saying we sell at 50% because many other retailers sell the branded products. For example, they sell Bose or Apple or Samsung or other branded products. Our strategy is more like Zara, where we make our own brands, in-house brands, and we sell product that seems much lower than their nationally branded products. Now, we also have set the guardrails of 60% plus gross margin and leverage to give to the shareholders. So if you were to go out and buy the customers that many e-com companies have initially, then we can scale the business rapidly, but that will entail lower gross margins and maybe high marketing costs that will dilute our EBITDA margins. So we keep our guardrails in place, continue to gain market share, and continue to gain leverage at the bottom line. So that is our business model. Within that guardrails, if we can achieve higher growth rate, we will.
Okay. Okay. Thank you. I'll get back in the
Thank you, Rishad.
Thank you. The next question is from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, thank you so much for the opportunity and congratulations again, sir, on a steady quarter. So the first question is more of a macro question. So any impact on our business model due to Trump getting re-elected? As in we import all our materials into the US. So from your past experience with the earlier Trump administration and, current developments, any comments on that?
Yeah, thank you for the question, Nirvana. Now, we believe that we are the lowest cost producer and the tariffs would impact equally everybody. So we don't foresee us getting impacted any adverse. In fact, with our gross margin of 62% plus, our costs will be lower than other competitors because their gross margins are lower. So we'll be at advantage if at all the tariff across the board comes into picture.
Sorry to interrupt. May we request Mr. Laha to please rejoin the queue? Thank you. The next question is from the line of Rupesh Tatia from IntelSense Capital. Please go ahead.
Hello, sir. Am I audible?
Yes.
Okay. Sir, first question is on this budget pay or financing. So, sir, very fundamental question is why do we finance these purchases through our balance sheet? Is it not better to, do some partnership and let the financing be on someone else's balance sheet? Maybe I don't have historical context of it, but maybe if you can explain that a little bit. And then the second question is I see in finance related to that only is in FY23 we had 26 crore as impairment. In FY24 we had 33 crore as impairment. This is significant compared to our profit after tax. I mean, if I look at it, it's almost 20-30% of our profits. So maybe you can explain, what kind of ROA we make or what kind of, interest rates we charge and how are we covered? I mean, how are these impairments considered in our model?
Yeah. So thank you for the questions. I'll go to your first question, the budget pay. So we have fairly good experience with the financing we initially started. When we started, we explored the option to financing from a third party. But there's two issues we have found. One is the financing cost was higher. Also, the customer experience, while many of the customers were not getting credit as their credit allocation from the different financing companies were higher. So then we have find out that it's better to offer ourselves as we give a better experience as well as our bad debts and the financing costs lower than the third party. So over the years, we managed to keep the lower bad debts rate, even with the financing cost of, or let's say interest cost of 2-3 months, we even better than the other financing companies available out there. That is why we went for the option, and over the years we have optimized quite pretty well, and we are pretty steady on our doubtful debts ratio and the financing cost side. The other point you mentioned about impairment, I'm not exactly where you are mentioning that this number in FY23, actually 22, actually we have a gain of 28 crores, which was a PPA loan that we have shown in our exceptional items. It was actually again a subsidy that we have received from US government at that time during the COVID year.
Sir, I am looking at annual report. Sorry to interrupt, sir. I am looking at the annual report. There is a line in other expenses, impairment losses on financial assets, allowances for or write-off of doubtful debts. There is a line item in other expenses in your annual report.
Yeah, it is actually a bad debts. It is actually a bad debts on the budget pay EMI options that we offer to the end consumer. It is roughly, this is around 1% of the cost to sales ratio, and it is in line with, I think, past many years, if I am referring the current number that what you mentioned.
So 132 crore in FY24. If that is 1%, then the total asset under management will be 3,200 crore. I don't think that is the correct number.
Yes. 32 crore, if I refer on the financial annual report, 32 crore is a 1% of our 3,000 crore top line.
No. But you are financing 40%, right, sir? So this is roughly 1,200 crore.
No. It's okay. I got your point now.
Yeah.
So our financing 40% is the ratio of the customer who opt the budget pay. So budget pay varies from 2 installments to 5 different installments. So first installment we collect upfront.
Okay.
So that's why the outstanding is a different than the sales ratio which I mentioned in my commentary. It is 39%. So outstanding varies based on 2 months to 5 months different installments. But the outstanding installment debt, as you refer in the financial, which is 32 crore.
So what is the interest rate that we charge, sir? I mean, how, because this number sounds really high to me.
Yeah. So we don't charge interest to the customers. It is an interest free for the end consumer. That and you can say that the balance sheet bears the cost of interest. Customer don't need to pay, but the advantage is that customer get pretty well adoption of the wherever we offer to the customer a budget pay option. And many of the cases where we have opted to the third parties, so credit third parties don't give to the good customer as in our internal credit score, but third party don't give the credit to them. So eventually we may lose the sales. That is why we went for our own financing.
Okay.
I also see in my financials, this is Sunil Rupesh. So I see in my financials for H1 FY24, the bad debt was $1.652 million for H1 FY24. So the velocity of the bad debt is approximately $3 million a year. So it was $2 million in H1 FY24 rupees. There was 16.52 crore rupees of H1 FY24, and for H1 FY25 it was 13.55 crores for H1 bad debt. So what you might be seeing is just a doubling of that for the full financial year, about 32 crores of the bad debt amount for towards the budget pay. And
yes, sir,
all three organizations, US, UK, Germany.
Yeah, it's just that the number sounds really high to me, sir. I mean, 1,200 crore, let's say, I mean, I don't know, 40-50% you're financing On 1200 crore financing, 32 crore is roughly 3% hit to the margins, and that number sounds really high to me. So that is my point. Maybe, I don't know, you can...
So let me give you one more reference. Any third-party financing company we go, there is one more company available like FlexiPay in UK. They charge straight away 7% of sales. Regardless of EMI options, they charge 7% of sales. Different financing companies, they don't go below, even when the interest rate were lower, around 1-2% during the COVID or before COVID time, the minimum financing cost from the different companies was 3-4%.
But that is to the customer, right, sir? That is not to us.
No. That is to us, because it's a zero cost for the customer.
So we can't charge from customer because our competitors don't charge from customer.
I see.
Bear this cost, whether it's our balance sheet or we take it from outside factoring.
Okay, sir. And the second question, sir, is on the content and broadcasting piece. So that also is a very first principle basic question, that we were doing 350 crore spending in FY22. I think that number went to 415 crore in 23, 500 crore in 24, and now it's going to be 600 crore in 25. So that number has gone up by 80%, and adjusted for acquisitions, our revenue has grown by not even by same amount. I mean, our revenue has grown by 200, 300 crore, adjusted for, $35 million if I adjust between Ideal World and Mindful Souls, the revenue hasn't grown. So, I mean, maybe you can talk from your experience or whatever is your internal modeling, but this incremental 250 crore spending that you are doing on content and broadcasting, can it bring, let's say, 1,000-1,500 crore revenue to us? And then in at what time frame? That is, I mean, if you can explain that a little bit internally, how you look at, success of this spending, that is one. And then the second question is, some other Indian platform company I track, and they basically don't do any ad spending if the sales velocity is good. They basically do spending only when the sales velocity or customer acquisition numbers start going down. And over the years, it has worked phenomenally well for them. So at a first principle level, I mean, can you justify this kind of spend to yourself and to probably to me, to investors?
So thanks for the question. This is Sunil. There are two components of content and broadcasting cost. So one is the airtime cost. So one is the airtime cost, and other is the e-com marketing cost. So we look at the different criteria for both these costs. Now, within the airtime cost, we started Germany 3 years ago. So there's a upfront fixed cost, as I mentioned in my earlier comment. And Ideal World, we started 1 year ago. So that is upfront cost. So Germany will break even in this current quarter and next quarter. So in H2, it will be at EBITDA level, it will break even. But the cost is already up there for 35 million homes. For Ideal World, the cost is there for 27 million homes. As it scales at a fully allocated basis, it will break even this quarter. So the upfront costs are there for the airtime. Also in US, we took an airtime with a lower channel position that will give us a growth in coming years. So we made these 3 investments in airtime that ramped up the cost for future sake. Now, second component is digital advertising cost. We started ramping up digital advertising about a year ago. And there you see the content broadcasting costs go up noticeably because of that. And we are seeing benefit of that in terms of new customer acquisition. And that customer lifetime value is 1 year lifetime value of that customer is higher than the customer acquisition cost for us. At all the 6 brands that we have within VGL portfolio, at each brand, the 1 year margin is higher than the customer acquisition cost. So with that strategy, we started spending, ramping up the spend on digital marketing. Now, your third point was about the Indian companies who don't spend on advertising till they see the ramp slow down. So our model may not be apple to apple with the Indian model. I've not studied the companies you mentioned, but with our competition within US, UK, and Germany, we don't see organic customers coming in at our scale. Maybe at Amazon scale or Walmart scale with their footprint or their momentum from earlier spend that they have done, they may get a lot of organic. But within our space, from Google SEO that we do or Bing SEO we do, the sales is not as meaningful from organic sources as there might be from the Indian companies that you're comparing.
Okay, sir.
So then, Mr. Rupesh, may we request you to please rejoin the queue?
Sure. Thank you.
Thank you. The next question is from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, thanks for the opportunity again. So following up from what the last participant was asking, so the content and broadcasting costs this quarter has seen a fall QOQ. So has this number now peaked out for the foreseeable future? And for the coming quarters on an absolute basis, how do you see this number panning out? It was 154 crores in this quarter.
Yeah, so for television, this is Neil again. For television, we see this number to be, we foresee numbers to be relatively flat, unless we come across a major opportunity that we don't want to miss. But we don't have anything in offering. So we foresee this to be flat. For digital marketing, we will continue to gradually ramp up as we see productivity gain within our digital space. So, but as a percentage of revenue, you won't see any meaningful increase. This year we expect it to be 18% by the end of this financial year. And for going forward for next few years, you can expect this to be 18%. Maybe slightly lower, but leverage may not come a lot from this particular area. The leverage will come from HR costs because our costs are largely fixed, some SG&A, and some from margin improvement as we scale the digital portion, because the margin on digital portion is relatively higher than television portion.
Okay, so it will come from gross margin on digital side. Yeah.
Yes. Yeah. Digital space has a higher gross margin than the television space.
And sir, so you said it will continue at 18%, but sir, right now, if you were at 20% in H1 and you're guiding for 18% for the full year, so for H2 you have to be at around 16% to achieve that 18% guidance. So you're saying H2 you'll be at 16 and then you'll again ramp up to 18 in FY26.
For the whole year, yeah, because H2 is usually higher revenue and the cost as a percentage of revenue drops because it's a fixed nature, airtime cost. The percentage expense as a percentage of sales drops, and for the next years, H2 may be higher than 18%, and H1 may be higher than 18%, and H2 will be lower than 18%.
Okay, got it. And sir, out of this 154, can you split this between TV and digital so that we understand exactly what part will grow and what will not?
Yeah, out of this 18%, 11% is related to airtime cost and rest 7% related to the digital marketing cost.
Sure. And this 7% is digital spend where exactly? In platforms like Meta and for SEO, if you can break that down a little bit.
Yeah, so majority is spent through Meta, but there's some portion in different affiliates, SEO, Google, but majority of spent through Meta.
Okay. And business-wise, is it possible to split the 7% between, say, Mindful Souls and the US business, UK and Germany?
Yeah, internally we do. Like Mindful Souls is a pure D2C company which has a higher digital marketing cost compared to US and UK business. So model is a different in the other brands. So percentages varies between the different brands.
Sure. Would it be fair to say that half of the 7% probably goes to Mindful Souls?
Not exactly half, but good amount of portion to Mindful Soul.
Okay. And on Mindful Souls, can you tell us what was the YOY and QOQ revenue and volume growth?
Yeah. So Mindful Soul is QOQ is flattish for what we are seeing right now, but month over month in recent months we are started seeing improvement in Mindful Soul, and profitability is also getting better with the regional supply chain has started from benefited from October onwards. And then the upcoming season events that we are seeing and 4 different new products we have launched in couple of months back, subscription program. So expecting the subscription numbers will improve, which will reflect in improving our quarterly and monthly revenue going forward.
Sorry to interrupt, Mr. Laha. May we request you to please rejoin the queue?
Sure, I'll read.
Thank you. The next question is from the line of Anuj Sharma from M3 Investments. Please go ahead.
Yes, thank you for this opportunity. Couple of questions. If you look at the broadcasting cost, basically the airtime over a long period of time, what is the inflation we can expect in this particular cost?
So the per home cost doesn't go up unless we take the home in a better channel position. And also the number of homes is not really expanding. So from cable is shrinking, but we are moving from cable to OTA home, that is over the air homes. So those homes can be a little more expensive than the cable. So if the mix changes, then the cost may move a little bit, but per home, wherever we are, hasn't really gone up to us per home basis.
Okay. And when there is a shift in the mix from TV to OTA or OTT, what's the inflation or what's the premium you have to pay per household, suppose?
So it depends on channel position. From cable, the normal cable we used to have in hundreds, and the OTA usually is in 30s, 40s, 50s. The cost is almost double, or sometimes even more than double. But that universe is smaller than cable. Cable is about 60 million homes in US, and OTA is about 23 million. So it's about just about 1/3 universe.
Got it. And also, we have been investing in digital, but can you just explain how do you go about budgeting this digital spends? How do you really forecast, or what goes through your mind deciding the budget on digital? That will be helpful.
Yeah, so digital usually is linked to productivity of the spend. So if we see the spend productivity is coming down, then we ramp down the spend. And if you see the productivity is strong based on our criteria, what is the ROAS we look at? So different platform has different ROAS. Meta has different, and Google branded is very different. Google paid shopping is different, and affiliate has different. So we look at those productivity measures and ramp up and down. Overall, we look at a total band of, say, if you have $1 million spend budget for the month for all the brands put together. Some brands sometimes spend more because they see more productivity. Some brands spend less because they are seeing. But overall, we are pretty close to our projection.
Okay. And these questions are on the budget schemes. So what disincentive a customer has? So assuming there is no interest and there is option for 2 installments, 3 installment, 5 installment, and outright pay, wouldn't it be logical from the customer viewpoint to take 5 installment or the maximum installment? And do you see that shift happening? I mean, people from upfront going to, let's suppose, the maximum possible installment, which is free of interest. How is that shaping up?
So we leave the decision to the customer. We offer that customer has an option. If we are offering for budget pay, ideally we would like that customer can opt it, because margin of the product decide based on that. but it's up to customer if they want to pay a full amount or go for a EMIs. Some of the customers, they don't want to take a risk for credit default, which may take their credit ratings lower. They pay full amount, but it's up to us, or up to the customers who want to take the budget pay options or not. But we offer for the unanimously for the products for all the customer, not distinguished from particular customer based on their whatever credit score.
Okay, but logically, if it's interest free, won't the customer gravitate towards the maximum installment option?
Yeah, logically you're right, but we see that customer opt also, majority customer go for the budget pay, but some of the customers are also, they don't go for budget pay.
Okay, but would you disclose the breakup between the 2 installment, the 3 installment, and 5 installment, and how they are shaped up over a period of time, maybe?
We do for the product 2 installment, 3 installment, 5 installments. Customer can select based on the available installments.
No, I'm saying from an investor viewpoint or shareholder, would you classify what percentage of that 40% is availing the 5 installment versus the 2 installment as a bucket?
So this depends on how much we offer. So every product has a unique feature of from 2 to 5, and whatever we are offering, they can either take that or they have to pay full. So about 40% customers we offer budget take a budget pay. Some products we don't even offer anything.
Okay.
So for that product, they have to pay full anyways if they want to buy, especially lower price products, $10 or $15 product. We don't offer any budget pay.
Okay. And my last question is, let's suppose a customer defaults. What are the recovery options we have? Generally, what process we follow for recovery, and when do we generally give it up, saying that the cost of recovery is higher than the estimated recovery amount?
So there's a system already built accordingly. After how many days the payment need to be retried, after how many days of interval payment need to be adaptive acceptance or card updater or token updater happens, and after how many days that we send the reminders to the customer via email or physical letter, then later on transfer to the debt collection agency. So this was the process, pretty long process, robust process that we have, that we follow for when we see failure in the installments payment.
Okay, and my last point is, if the customer really defaults, his credit scores are impacted. Is that correct?
Yeah, so we don't, unless we pass on to the debt collection agency, then score impacted. And we don't transfer that if it's a really substantial amount to the debt collection agency, but only impact once we transfer to debt collection agency. Otherwise, it doesn't impact the customer credit score out there. But internally, as soon as customer do a default, then customer can no longer buy on the budget pay option, while they can buy a full payment.
All right. Thank you so much. Thank you.
Thank you. The next question is from the line of Pradeep Mehti from RGI Meditech Private Limited. Please go ahead.
Hello.
Hello.
Hello. Yeah, thank you, sir, for giving me this opportunity. I have couple of questions. My first question is, what is the gross margin for digital revenue? Can you comment any exact number?
So gross margin for Meta products or certain Google products is anywhere from 65% to 75%, depending on product to product.
Okay, I actually want to know about total, actually average gross margin, total digital revenue.
Now, total digital revenue has a lot of components because we also have rising auction, $1 auction, where we sell product at 5% or 7% margin only. There is a clearance mechanism because we come up with 100 new products every day, and the small quantities are not sufficient to sell on television. We sell through auction. So
average gross margin, sir, for digital revenue.
So I think including RA and excluding RA. Yeah, so I'll have Prashant pull out that number. In the meantime, you can ask some other question.
Okay. When the digital revenue become 50% of total revenue?
Yeah, so the rising auction will be limited because it won't rise as a percentage, but the other margin, other component, there is a fixed price catalog or Meta or Google product, overall margin will go up even further. We are not giving separate guidance of that, but that margin will go up higher.
Okay. And my second question is, why company sold the Encase Private Limited? What is the issue with that company?
So for the Encase, that we were finding that earlier our idea was to get a China plus one strategy and get a cheaper packaging products which we use in US, UK and Germany for the end consumer. Now we are finding that many of the products is available out there in China itself with the even lower pricing after duty. So and the margin is not in line with what we guided to our investors as about double-digit margin that we are guiding to investor is not coming with that business. That is why we decided to exit that and source it from the third party China.
Okay, and with that last one question, what was its acquisition cost when we bought that, our company bought that, and what is its selling cost?
Yeah, so we invested in this company roughly around 4 crores and we sold that in around 50 lakhs.
Okay, that means 3.5 crore approximately company lost in that acquisition. Am I right?
So yes, right. And we already booked that loss in March 24 accounts.
Okay, sir. Thank you. Nothing else.
Thank you. The next question is from the line of Angad Kadare from Samiksha Capital. Please go ahead.
Thank you for the opportunity. My first question is in our cash flow statement, there is a grant of loan of 7 crores and also an impairment of loan of around 1 crore. Can you throw some light on these two line items?
Sure. So this was the loan related to the Encase packaging which was outstanding for a long time. It is the same loan that we have done a mortgage of the property lying with the Encase packaging, the land and building and plant and machinery. Though the mortgage and the property valuation was coming and fully covered with the loan outstanding, but for the conservative accounting, we have taken a loss and booked the impairment of 1.1 crore for this outstanding loan.
Okay, and my second question is on the inventory days, it has increased from 72 to 86 days. I know it's due to the the upcoming festival season, but fair to assume this as a base going forward, or if not, then what can we take as a sustainable inventory days?
Yeah, so we expect the after season, that is at the end of December, as well as end of March, the inventory comes down because we run two clearances. We run December clearance and we run March clearance, and inventory steadily comes down. So from the days point of view, so you should look at the last year's days as a guidance for your future projection.
Yeah. And even if you refer the cash conversion cycle, so we have maintaining around 170 days cash conversion cycle in payable, receivables and days. And this we internally we are keeping the similar kind of cash conversion cycle for upcoming period around 170 days.
Okay, so if there is a clearance after December and in March, just assuming, will the gross margin have an impact on that? Will we have an impact in that quarter?
So that is why our first quarter margin was pretty healthy to 66%, and the second quarter and the full year guidance that we have given 200 basis point improvement than last year. So full year we are guiding 64. So that guidance was incorporated in Q3 and Q4 clearance that we have planned. So it is baked in already.
Okay. Thank you so much.
Thank you. The next question is from the line of Rishabh Shah from Bugle Rock PMS. Please go ahead.
Yeah, thank you for the opportunity. So my question was, when a customer buys from your platform once and then he doesn't have a repeat purchase, so do you offer him any incentives for the retention of the customer?
Yeah, definitely. We have pretty robust email, text flows in place to get the customer back. So we increasingly increase offers for them to come back. The first offer is to offer a complimentary product. No, not complimentary, complementing product to what they bought. The second is for the free gift, and then percentage discount, and $10 gift card, and then $20 gift card. So we have a lot of these processes in place to get the customer back.
So my next question is, you target audience is 50 plus age group, and you are constantly investing in the OTT platforms also. So have you been able to convert the audience in the TV, or rather add new customers in the new generation platforms?
Yeah, so that's a good question, Rishabh. Now we have a lot of OTT sales, and sales growth is also pretty robust. But we have been able to move many of our existing customers over to OTT. But to acquire new customer, OTT still is a new area. We get a lot of app downloads, but still there's no ecosystem to convert those downloads into customer. So the new customer acquisition on OTT is relatively low, but the customer conversion, existing customer conversion over to OTT, who are buying from us and have cut the cable connection, or even existing customer who are still buying from television or e-com, and then them buying on OTT is pretty good.
Yeah. So just on the customer part of it, what is more important for you? Is it keep adding new customers or the conversion of the customers from one platform to another?
We both have KPIs on both fronts. So if we slow down the new customer acquisition, then the funnel will dry. So we don't want the funnel to dry up. So we want the funnel to be fully populated, and then once the customer comes in, we want to retain the customer, and then also move them to other platforms so that the lifetime value goes up. And when we move from one platform to other, lifetime value shoots up quite substantially.
Okay. Thank you so much. Thank you.
Thank you. The next question is from the line of Rupesh Tatia from Intelsense Capital. Please go ahead.
Hello, sir. Thank you for the follow-up. So my question is, let's say for 4,000 crore sales, whenever we reach, what would be the content spend velocity would we need? Is 600 crore spend enough, or we have to go to, let's say, 720, 750 crore kind of number?
So the television broadcasting, we expect that to stay relatively flat. It may go up a little bit, but relatively flat. But the digital cost may go up, because as we scale up our digital customer acquisition and retention, so that may go up. So as I mentioned earlier, in longer run, this 18% may stay relatively flat. So our internal position is showing 17 to 18, but guidance I want to give to you is relatively flat. The leverage will come from HR cost, SG&A, and margin improvement.
So just to summarize, even at 4,000 crore, you expect 17 to 18% content and broadcasting cost.
So that is the guidance I want to give you, because it may go lower, but at this time, in our journey. I don't want to give a guidance below 17 on this one.
Okay. And then, sir, I mean, if I look at the model from gross margin to EBITDA walk, right? I mean, 60% gross margin, 20% employee cost, 20% to content and broadcasting cost, 10% maybe manufacturing, packaging, shipping, all that cost. So 60% gross margin results into a 8-9% EBITDA margin. And I mean, whatever operating leverage you are talking about in HR and all that is like 1-2% kind of thing. So to meaningfully see a jump from 10% to 15% margin, to me looks like gross margin is the biggest lever. I mean, your gross margin I think has to go above 65, probably close to 67, 68, and only then we can see, you know, mid-teen kind of margins. So what are your, you know, thoughts on that?
So first lever is the HR cost. So we have two new businesses, the Germany and Ideal World, and we staffed up substantially for these two relatively new businesses. And as they scale up, the HR cost will drop down quite substantially across the group. And we also believe as we are creating efficiencies through AI, we'll gain efficiencies in our knowledge workers across the group as well. So you'll see substantial gain in HR costs from currently 19% to it has the potential to go down as low as 13-14% in years to come. Now, the affiliate cost, that is the content and broadcasting cost, which is currently we expect it to be 18%, that may go to 17%. And SG&A, as we scale up, we'll see leverage there, because as you scale, the shipping cost goes down, the other areas goes down as well. The rents, the other expenses goes down substantially. And so margin may go up from 64% that we are projecting for this year. It may go up a couple of percentage or maybe 2 or 3% over the years, but other areas will also have leverage opportunities.
Okay. Thank you for answering my questions, sir.
Thank you, Rupesh.
Thank you. The next question is from the line of Parth Dalal, an individual investor. Please go ahead.
Hello, can you hear me?
Yes, please go ahead.
So for the Mindful Souls slide, we have mentioned there 4 new products for the quarter. And earlier, I think Nitin sir said that a lot of expense goes in that. So how to read this? Only 4 new products for the quarter, whereas our US, UK, you said that we have, you know, a big churn, like 100 new products a day.
Yeah, Mindful Soul is subscription business. For subscription business, there's a lot of thought and a lot of promotion that goes into a new product launch. Rather than on television, you make some changes to the ring or pendant or earring based on the stone that you have or the accent stones you have or the color of the scarf you have. So you get a lot of velocity coming in for television, because that customer watches us hours every day. So we constantly need to bring new for them without a lot of depth that a subscription business needs. And the promotion cost for the new product that we get in is very low or almost non-existent on television business. Whereas on e-com business, you have to promote a lot before that product gains traction. So it's a bit different business model, and not really comparable to television to subscription model.
Okay, so the 4 new product that is mentioned is then subscription products.
Correct.
Mm-hmm. Okay, and so do we have budget pay in Germany? The same setup that we have for other 2 regions?
Yeah, we don't have budget pay. Actually, it is a pay by invoicing. So it is for 21 days payment after receiving the item. So installment payments we don't have that. It's just a payment 21 days credit to the customer in pay by invoicing.
Okay. So what is stopping us to, start the budget pay setup there? Is there any regulatory limitation?
Yeah, it is. We're finding it is not easy to operate with the pay by invoicing, and the other competitors are also not offering to the end consumer. While in UK and US, that competitor offering the budget pay. So we are not going until we see a profitability, a good margins over there, then we can think of to offering installment payment program.
Got it. Agreed. And in the same slide for Germany, it is mentioned immediate TAM increased by 20%. So is this recent thing? Anything that has happened recently, or how are we comparing this 20% year on year, or what is the time period?
Yeah, just a moment.
So actually, yeah. So it means that when we started Germany, so comparing to UK, US, where we have our existing market, starting Germany has increased our addressable market by 20%.
Got it. And final one from my side. So any other acquisition on the cards, sir? Anything on the table with the management?
So not anything on the horizon. Our aim is to get Mindful Soul starting scaling up, and Ideal World giving us meaningful positive EBITDA before we go for new one. But nothing on the horizon right now.
No, sir, because there was this social media post somewhere which said Vaibhav Global looking to acquire Create and Craft in UK. So I don't know if there is anything to read in that.
No plans right now.
No, okay. Got it. That's it from my side. Thank you.
Thank you, Parth.
Thank you. This will be the last question, which is from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, thanks a lot for the follow-up opportunity. Sir, the digital growth this quarter, YOY, was only 11.8%. This was without Mindful Souls in the base. So next quarter onwards, we'll have that in the base. So what is your comment on this growth and organic digital growth? What kind of number are you targeting going forward?
Yeah, so we had some new airtime coming for Ideal World in US. So those new airtime gave us more television growth, and the digital was not as robust on that one. But going forward, we expect digital growth to be faster than TV growth.
Sure, sir. So just doing some math, the numbers that you said about 18% content and broadcasting and the 11% part remaining more or less fixed, which is to do with TV. So I think you're planning to grow the digital spend by 15% year on year for the next few years. So will the digital growth therefore be higher than this 15%, in line with 15, or how will it be?
Actually, if you refer that past 10 years, digital CAGR is 18%. It was actually without the aggressive investment on social media marketing. And we expect that this growth rate will continue to grow as we are investing more on social media marketing. So we are expecting that the growth rate will be higher than the investment of 15% that you mentioned year over year.
Okay. And sir, when you say that gross margin for digital sales is higher than TV sales, what is it driven by? Are we able to sell costlier products via digital, or how is the gross profit per unit going up in digital versus TV?
So in digital ecosystem, even when we compare ourselves with, say, Amazon or other D2C players, we find that the players have to absorb higher marketing costs, Meta costs or Google costs or affiliate costs. Therefore, the margin potential is higher in digital space than television.
Okay, sir. Not sure I understood the explanation. I'll take it offline. Last question from my side. Any plans on lightening the balance sheet, sir? I believe we made some investment in land, etc. in the US, which we are not using, since we have an ROE goal also along with margin. So any plans of working on the balance sheet to make it more slim?
Yeah, for that land, we are looking for rezoning of that land into partial commercial and partial warehouse come light office use. Once we have rezoning done, then part of that land will sell for retail, local retail, and that may lighten the balance sheet from that extent. And we don't foresee much capex in coming times, so balance sheet will continue to be lighter than we had in the past few years.
Got it. Got it. Thank you so much, sir, for answering the questions, and all the best to you.
Thank you, Nirvana.
Thank you. As this was the last question for today, I will now hand the conference over to Mr. Sunil Agrawal for closing comments.
Thank you. I want to thank all the participants for your time and great questions. If you have any further questions, feel free to reach out to Prashant Saraswat at VGL or Amit Sharma at AdFactors PR India, and we'll be happy to answer your questions. Thank you once again.
Thank you. On behalf of Vaibhav Global Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.